Okay, hi guys. Trust everyone is well and safe and listening to us from the comfort of their homes. My name is Keith. I'm the co-founder of RealVantage, and we are very pleased to have you. We are very pleased to have you today. In our earlier webinar, which we conducted a fortnight ago, we provided an overview of the potential impact of the COVID virus and shared our perspective on real estate investment during these challenging times. We also highlighted that adopting a core investment strategy will be our preferred mode. So to provide the context of our investment strategy, we're giving you an overview of the various investment strategies that real estate fund managers around the world would employ. Right? We also share how global institutional investors such as GIC, Blackstone's, how they look at the risk and return dynamics of a deal. Right? Next, we'll dive deeper into the rationale of our core strategy. So joining me today are my colleagues Chi Xiang and Mark. They're dialing in from their homes. Right? Chi Xiang was with Partners Group, a global real estate fund manager. Next, Mark. Mark has been active in investments and research throughout his career, and he was formerly with Deutsche Bank and Pacific Star. Right. Okay, before we start, everyone is in a somber mood. Thought I'd just start by sharing some light-hearted cartoons. Right? So these cartoons are by this gentleman called Kevin Carl. He's what we call a political cartoonist, a regular contributor to the New York Times. So here are some of his newest works. Okay. So like everyone else, we like to take a pot shot at Trump, right? Here's one of him trying to encourage everybody to start business during Easter. So as you can see that he's dressed like an Easter bunny. Next one is about him coming up with a fantastic, what we call a tremendous plan on how to deal with the virus. He tells everybody to stay calm, don't panic. And finally, actually, what's his plan? His plan is who to blame, basically. So he blames on Hillary, Obama, fake news, and so forth. All right. Okay. Let's start. There are some users who are new to our platform, so I thought it's good that we give a quick brief about our platform. So RealVantage is a real estate online platform that provides investors with institutional real estate deals. So what we do is we source, evaluate, and analyze these deals. And once we find a deal that is which we are comfortable with and has already cleared our investment committee, we'll put it up for funding. Well, once the deal is fully funded, we'll act as a real estate fund manager. We'll acquire the deal. We'll manage the asset over the investment period. And at the end of the investment period, we'll seek the best possible exit for you. So for those who have invested in overseas real estate, you can appreciate the pain points in management and the risks involved. Right? So at RealVantage, we aim to solve these issues for you. Right? Through fractional ownership, you get to diversify your reach through smaller ticket sizes. Our investment starts as small as 25,000. You get exposure to different markets and different sectors as well. So once invested, the assets will be professionally managed during the investment period, so you can just sleep tight at night. And finally, the key point is we also pride ourselves in providing better quality deals. I mean, access to deals that you don't normally get, right? We share more with you in the next few slides. Next, we feel the concept isn't as good as the team behind it. So let me do a quick introduction of the RV team. So collectively, we have an average of 100 years of combined experience in real estate fund management, private equity, and technology. On the real estate front, together with our advisors, we have transacted more than 10 billion in real estate across Asia Pacific, Australia, and also across all sectors from residential to commercial. Right? Many of us also come from esteemed organizations such as GIC, Barclays, and Deutsche Bank. Right? Okay, let's jump into the topic for today. We will be starting with an overview of the real estate strategies led by my colleague Chi Xiang. Next, my colleague Mark will dive into why we decided to pick the core strategy. And finally, we have a Q&A segment. Okay, let me hand you over to Chi Xiang now.
Okay, thanks Keith for the introduction. So now I'll bring you guys through the real estate strategies and risks. Before that, I would like to give an overview of the various real estate investment options out there in today's market. For most individual investors, real estate investing is limited to public listed REITs or buying directly into residential properties like condominium and renting it out for rental income. What many of you do not realize is that in the world of real estate investing, there's a lot more options out there. So here are some of them. Right? Examples are like asset repositioning, development projects, and lease-up opportunities. However, they are mostly confined to the playbooks of institutional investors such as sovereign wealth funds, GIC up there as you can see, or pension funds, insurance companies, family offices, as well as ultra high net worth individuals. These investments usually come at higher risk and would require greater investment management expertise to navigate the higher risk involved. Now, all these options can be broadly categorized into 3 strategies. So here you can see they are namely core, value add, and opportunistic. Though there can be more depending on how detailed this risk curve is being divided. But for today's discussion, we will focus on these main 3 strategies. Now, starting from the lower end of the spectrum, we have the core strategies, which are the least risky investments that deliver about 7 to 9% per annum. It's also worth noting that there is an extension of core strategy called Core Plus, which are properties that have the ability to increase cash flows through light property improvements, management efficiencies, or by increasing the quality of tenants. The returns for Core Plus strategies are typically in the low teens. So moving up this risk curve, we have the value add strategies that are of moderate risk, and they generate around 10 to 15% for investors. At the other end of the risk spectrum are the opportunistic opportunities. So these are the riskiest in nature, and investors will typically look for returns of at least 18% to compensate for the higher risk. The value add and opportunistic strategies are where most individual investors do not have access to due to the greater investment skills needed to manage the higher risk and larger capital requirements. So in the subsequent slides, we will dive deeper into what each strategy entails and provide a couple of case studies by Keith after we have go through the characteristics. Now before that, we would like to explain the risks involved in real estate investing and how it applies to the 3 strategies we just discussed. Although this is not an exhaustive list, but should provide a pretty good picture on the general risks that investors will be exposed to. A reason why it's important to understand and appreciate real estate risks is because many investors are very excited when they hear about high returns, but they often underestimate the magnitude of risk involved and are unprepared when something goes wrong. So, this risk can be generally classified into 3 baskets: economic, real estate specific, and then regulatory and environmental. So for economic risk, there is market, interest rate, and currency risk, which applies to not only real estate investments, but all investments out there, be it equity, bonds, or commodities. So examples would be the global economic downturn that we are experiencing right now, which has caused turbulence in the markets, interest rates, and currencies to fluctuate massively. In the second basket, real estate specific risks are risks that are unique to the real estate asset class, such as technical, tenant, or development risks. So unlike the other types of risks, real estate specific risks are usually within the control of investment managers and can be directly mitigated through various measures such as vigorous underwriting and robust business plans. Next, we have regulatory and environmental, which results from government policy changes. So some of these policy changes could be increases in land tax or water charges or like capital gains tax, which will have real impacts on the property's cash flow. So environmental risks includes hazard risk, which pertains to the soil, building material, or paints that are used in the property. So these might have hazardous effects on the immediate environment. And these problems could potentially reduce the future value of the property or incur great costs to remedy. Now, let us look at how these risks interrelate to the respective strategies. Evidently, core strategies are the least risky overall, therefore they offer the lowest range of returns. As for value-add and opportunistic strategies, investors would command higher returns to compensate for the higher risk involved. Let us take a look at how these strategies play out in the institutional space. Every year, numerous new funds are raised in the private markets across the world, catering to the various investment strategies. Here are some of the biggest names in the industry that have raised flagship funds one after another, expanding their portfolio with assets that fit their primary investment strategy. Alright, now we will discuss each investment strategy in greater detail. Before we start, I just want to be clear that these characteristics are generic in nature, so they could vary depending on the exact details of the investments that we are looking at. So, with that in mind, let us get started. First, we'll be looking at core strategy. This is the typical deal matrix of core investments. Now, the sources of returns would mostly come from operating cash flow and little from capital appreciation. What this means is that most returns will be realized from rental income, which investors receive on the monthly or quarterly basis. The remaining returns come from the capital value appreciation of the property, which will typically only be realized upon selling the asset. One of the pros of core investments are that cash flows are stable and secure, as the in-place lease is usually very long, from say 5 to 10 years or even more. And the credit of the tenant is typically very strong. The tenants could be like Amazon or Walmart. Another advantage is that only a light touch of asset management is required, as the property is usually quite new and well maintained. The downside here would be that expected returns are in a lower range, because these assets usually are situated in prime locations where prices are relatively higher, leaving lesser room for capital appreciation. Adding to that is the longer investment hold period that comes with core investments. Due to the fact that most returns come from operating cash flow, investors will need to hold onto these investments longer in order to realize meaningful returns. Examples of such assets are like prime CBD office buildings, retail centers, and selected industrial warehouses. Next up, we have value-add strategy. And here we can see that from the sources of return, approximately 50% will come from operating cash flow and the other 50% from capital appreciation. This means that a higher proportion of returns are back-ended and only realized when the property is sold. Now, the pros of this strategy include benefit of upside potential from selling the property at higher value, but this will depend on a successful execution of asset improvements. This strategy will also allow investors to cash out earlier as compared to core investments. The cons here would be that this value-add strategies is highly asset management intensive, as one can imagine, with all the work involved in repositioning or to lease up the property. And also, the success of value-add would also depend on market cycle. Though this is not necessarily a bad thing, timing the market is near impossible, as I'm sure we can all appreciate. Black swan events like the COVID-19 situation now can have huge impacts on the market and greatly affect risky investments like value-added ones. Some examples of these value-add investments are like secondary properties with depressed levels of income or value has fallen in contrast with the broader market. Finally, we have opportunistic strategy, where most of the returns, right, usually 80% or more, are back-ended, and lesser than 20% are from operating cash flows. This provides less certainty to investors, as the return of capital and profits are realized in the later stage of the investment. The pros of this strategy include larger upside potential and relatively short hold period when compared to the earlier two strategies. And downsides here will include that most of these returns are back-ended, as mentioned earlier, And similar to the value add strategy, the success of opportunistic investments would greatly rely on being on the good side of the market cycle. Opportunistic investments are usually more exciting and promise greater returns, but it's important to bear in mind the riskiness. Being equipped with the right skill set is pivotal to the success of this strategy. So now let Keith take you through a couple of case studies to better illustrate the various strategies that we are talking about. Keith.
Okay, thanks Ji Xiang. This is Keith again. Right. Just to recap, essentially it's a risk and return dynamics. Right? Core deals are lower risk, which essentially means lower returns, and right up the investment spectrum, which is opportunistic, which are higher risk and high returns. Right. So these are some examples of deals according to the 3 different categories of risk. Some of them are deals that RealVantage have funded. Some others are the ones that I've done personally. Right. Now let me take you through first one. It's a core strategy here. This is an office building located in the heart of Geelong in Victoria. The property itself is leased to a government department. The lease itself runs for 10 years. The government department anchors 94% of the property. The property was built in 2009, which is relatively new, right? So given these characteristics, this deal is considered core, right? Why? Why do we call it core? Because it's high level income security, a AAA rated government tenancy, and it's on a very long-term lease as well. However, on the flip side, the rents have limited upside as they are fixed. So now, given the nature of the long lease, the capital value of the asset might be capped as rents upside is limited. However, the capital value of the asset is also very well protected because the income stream is secured. So there's also a limited downside, right? So what's driving the returns for this asset? The returns for this investment essentially derive from the secured cash flow. So as you can see right here, the returns that is projected is about 9%. So this essentially is the returns coming out from the rental, right? Typically for core deals, real estate fund managers would not give a very big capital value appreciation, right? Simply because the rents are locked in, all right? Next one to highlight is a deal that we have funded. It's also a core deal. This is a service station, what we term as a petrol station here in Singapore. So it's located in Perth. It's on a fresh 15-year lease to ExxonMobil. ExxonMobil, as you know, is one of the strongest petrol companies in the world, actually. Right? The lease is itself is termed as a triple net lease, which means the tenant is responsible for all outgoings, maintenance, as well as capital expenditure. So there's no other costs that the landlord needs to worry about, right? All the property-related costs, maintenance, running costs, and so forth, are all paid by the tenant, right? The lease itself has a fixed 3% increase every year. So given the nature of the lease, right, the upside of the rents is also capped in that sense. So similarly, it displays a very core characteristics, right? The returns are largely derived from the rental that the tenant pays, right, which is about 8% per annum. Right? All right, next, moving up the risk curve is a value-add property. So this is a value-add deal that I was personally involved in. It's a portfolio of 5 shopping malls in Malaysia. The assets were well located in key cities in Malaysia. However, their assets are very old and tired. They're easily more than 30 years old. Occupancy was also low. Averaging across the 5 shopping malls, it were coming in about 70%. And the rents itself were trading below the market rates, right? So we went in and we acquired the assets at below market value, and we spent a substantial amount to spruce up the assets. What we mean by sprucing up? This means that we changed the layout of the shopping malls, we created new floor areas, we added new facilities, like a Cineplex. We also did quite a bit of facade upgrades and plant and machinery upgrades as well. Right? So there's a lot of asset management work involved in these sort of assets. So after the assets were upgraded, we managed to secure strong rents, and it jumped up by 25%, and the occupancy was boosted up to 95%. So this was an investment that lasted 4 years, and we managed to secure an 18% IR return. The next deal is the one that we have funded as well. It's what we call a refurb and lease-up strategy. Right? The asset is located in the heart of the Adelaide CBD, and it's one of the most prime locations. However, the asset was underperforming. Right? It was only 30% occupied. What we did, we went in and we acquired the asset at 40% below market value. Right? The strategy was to refurbish the ground floor, inject more F&B operators. We also went up. We also had the plans to refurbish the main lobby and the common leaf lobbies as well. Right? We felt that this was a good value at play because of a few factors. The asset is in a very prime location, number one. Number two is that the attractive price. We got it at 40% below the market value, right? So that gives us a lot of buffer to fix up the asset, right? This deal is still live, and we expect to divest in about 3 years' time. Right? Similarly, for this deal, we expect to generate a return about 12%, which is in line with the risk involved for our. The next deal is an opportunistic deal, which I was also involved in. It was the acquisition of the empty Grade A office building in China. The Nanjing IFC was located in the heart of Nanjing, one of the most prime parts of the city. The asset itself is a sizable one. It totals 110 square meters, and it comprises 51 stories. Right? This asset was acquired in a sort of distressed situation. The seller was in negotiation with another buyer. However, the buyer pulled out, and during the negotiations, the GFC hit. Right, so we went in and we managed to secure a good 30% discount for valuation. But you must appreciate the risk involved in this project. It's a empty building. A 1.1 million square feet building was totally empty. Yeah. So we went in and we managed to fix it up, spruce it up a little bit more, and we leased it up. We did a lot of active leasing, and within a year after we acquired, we filled up to a stabilized occupancy of 90%. Right. So this was considered a very opportunistic deal because of the risk involved. We acquired a brand new asset, but it was empty. It was a very sizable asset. So the risk in the leasing up risk was very high. Right? Okay, the next deal next opportunistic deal to highlight is one that we were involved in funding. It's essentially a ground up development deal. It's a townhouse development project in Sydney. It is considered opportunistic because it's a development project. So all the risks that we have spoke about comes in. You have to deal with market risks, construction risks, so on and so forth. For this deal, we are confident in managing the risks due to the following factors. Number one, market risk was considered small, as we were only dealing with 6 townhouses, and the market was starting to recover. Next, construction risk was also mitigated, as the construction cost was very locked in by the developer. Right? Next thing, the competition we felt was also limited, as it was bought into a tightly held market that catered only to the locals. Right? This deal is still live. We have now 1.5 years to go, but we are quietly confident that we are able to ride out the current crisis. Right? Okay, let me just hand it over to Mark now. He will speak about RealVantage strategies during this crisis. Okay, Mark?
Okay, I would like to start my section by sharing a very interesting chart. This chart displays the strategy preferences of institutional investors, and this was done through surveys usually carried out towards the end of the year. So, for example, the investment style preference for 2010 was probably surveyed sometime towards the end of 2009. And just to make a few observations, we can clearly see that the investment picture is highly static for institutional investors. They actively adjust the strategies through the economic and property cycles. And it should also be very clear that when it comes to real estate investment, sophisticated institutional investors deploy a very broad array of strategies. Now, it's also very interesting to note that the preference for strategies do follow a pattern, generally speaking. Now, in times of economic duress, you can see this corresponds to the circle on the chart now. During the last recession, that investors tend to gravitate towards a core and more defensive strategy, away from some of the higher risk strategies. And there's nothing surprising about this, because during this stage of the cycle, cap rates would widen during this period and would therefore create pretty attractive entry opportunities. Now, for those who might not be familiar, cap rates is a term that we use that refer to the yield of the property, usually the net operating income divided by the price of the asset. Now, so as the cycle matures over the cap rates compress, investors would then tend to migrate up the risk spectrum and seek out better returns. So you can see, like as indicated by the arrow, over the years from 2012, most of the investors would then gravitate towards the higher risk strategies. Now, so just as sophisticated and institutional investors actively adjust their strategies through the cycles, so should all of us. But before I dive into the views and the strategies portion, I would just like to quickly share with you some of the steps we have taken to better position ourselves as a firm to capitalize on opportunities while we safeguard the interests of our investors. And one of the first things that we did was obviously to get a handle on the situation. And we comprehensively mapped out and assessed the risk arising from the virus situation, identifying what's known and what we do not know yet. And we have recalibrated our investment views and strategies in light of this crisis, which I will share more in a while. And going into the crisis, we were tracking up easily 30 deals. And the first thing that we did was to flush out all the deals that no longer sit well within our strategy. And secondly, we are actively retooling the ones remaining, meaning to say that we are tightening all our underwriting assumptions, running deeper due diligence, revisiting the leverage assumptions, and very importantly, carrying out a pretty rigorous stress testing of the numbers, especially for years 1 and 2. And we also reached out to our contacts and best-in-class partners that we work with within the industry to let them know what we are looking out for in order to bring the deals into the pipeline that works best for our investors. Now, before I start on the views, I just want to say that we have, in a very recent article, shared some of our perspectives and more details, which can be accessed from our website under the section we call Real Insights. And I would invite you guys to check it out if you have time and share your views with us. So obviously, the economic impact is very significant. But more than just that, it pays to appreciate that the impact will be extremely uneven across regions, countries, and sectors. Just looking at early data coming out from China, all right, China was ground zero, also the first to emerge from the lockdown. As they came out of the lockdown, China's economy is now operating roughly at about 20% below their normal levels. And we think the outlook is even less sanguine for Western economies, especially for the late actors that will take longer to subdue the virus outbreak. And by the time some of them emerge from the virus-driven ice age, they may very well reset to levels of 70% or even less compared to where they were before entering the pandemic. And some even face the risk of permanent damage to parts of their economies after prolonged hypothermic conditions. Now, in the near term, transaction volumes will definitely fall significantly as both the buyers and sellers take time to reassess the situation. And well, from experience, this is also the time when the market views differ widely that parties with better research and acumen can find the best value. Now, we have also observed that a flight to quality has already begun in earnest within the credit markets, and for sure this will filter through to the real estate segment. But it's worthy to note that unlike the early stage of the GFC period, credit markets are still functioning, right? And credit remains available. But lenders have turned highly discerning over who and what they will lend to. Deals are still being funded for institutional investors during this period as we speak, but distress has also started for some of the most at-risk sectors such as hospitality. As an example, a liquidity crunch is forcing Singapore-listed Eagle Hospitality Trust to have to resort to raising cash by liquidating some of their assets. So discounted assets are already coming through, right? Some are already landing on our deal table. Now, in formulating our strategies, we just cannot emphasize enough the importance of distinguishing between what factors are structural in nature and what are cyclical. Similarly, along the lines of which are temporary and which are permanent, right? Some of the structural trends going into this global crisis would continue to dictate the trends coming out of it, in our opinion. Things like aging demographics and rising healthcare needs will remain pretty much on an unstoppable growth path. And in other areas, like for example, F&B might be under extreme duress right now, but we firmly believe that these will rebound strongly once the crisis has subsided. And yet, some of the changes could be more permanent. An example could be certain supply chains could experience some resets. Now, having experienced major supply chain disruptions, certain firms are now considering moving away from a globalized supply chain towards more localization and regionalization just to manage the security. And on this note, I would say we stress that we have to be very careful with distressed prices. Distressed prices that reflect temporary cyclical conditions to us are fine and in fact represent opportunities. But for sectors that are permanently impaired, even hugely discounted prices could very well mean something else. Now, we are already observing right now that cap rates are starting to widen from what was a record low period previously. And as real estate investors, we take a slightly longer term investment horizon. And we would expect beyond the near term that given the ultra low interest rate environment that we are staring down and the unprecedented liquidity sloshing around, that cap rates would eventually compress to even newer lows and remain lower for many more years to come. And while the focus now is pretty much entirely on the virus situation itself and the immediate repercussions on the economy, we envision many more potential aftershocks to come, with implications on the real estate when the virus episode is over. Just some of the examples would be it could be geopolitical fractures, social unrest, or political repercussions. So as unprecedented as these times are, the bigger picture may not be all that unfamiliar. Notwithstanding differences in the nature and transmission mechanism of this shock, there is much value in drawing upon past experiences. So as Mark Twain had said, history doesn't repeat itself, but it often rhymes. Now, before getting into the details of our investment strategy, let us review the relative performances of the various strategies through the last recession. So, this chart I'm about to show you plots the performance of funds adopting various strategies as measured by the median net IRR along the left vertical axis against the vintage year of the funds along the horizontal axis. So for example, this orange chart shows the performance of funds of various vintage years that follows a core investment strategy. But it's also worthwhile to note that these are average returns. So within each vintage year, there will still be core funds that outperform and others that come up short, right? Now, this would be the performance for value-added strategy, and the red one is for opportunistic. And we superimpose the fund performances against global growth, year-on-year growth chart. Now, property prices typically lag economic growth by about half a year, right? But in the absence of a global property price index, we will use the global growth data as a proxy. And do note as well that funds typically have a fund life of about 5 to 7 years. So one of the most obvious observation that we can make here is that, and also unsurprisingly as well, that the returns on value-added and opportunistic strategies display significantly more volatility compared to a core strategy. And as I mentioned earlier, within each strategy, for example, the opportunistic strategy, the returns, while they are represented by a single line, you can be sure that performances of the constituent funds would vary very widely. Now, I want to draw your attention to how core strategy performed during the times of extreme economic duress. And we reckon this is where we are now. And as you can see that the core strategy pretty much outperformed a value-add and opportunistic strategy during this time, right? And even as we enter an early stage of recovery, right? Yeah, you can say that the value-add and opportunistic funds have clocked a higher return compared to core strategies. But in our opinion, the risk premium of about, say, ballpark, if you look at the chart, 3%, 4%, that does not even compensate investors sufficiently for the additional risk that they are taking when they move up the spectrum. So on a risk-adjusted returns basis, we think that through the boom-bust cycle, that investors remain better off staying defensive with a core strategy as their primary strategy. Now, just want to wrap it up with more actionable strategies to share. Very importantly, we think that investors would do very well to adopt an investment horizon of at least 4 to 5 years. And by now it should be very clear that we will advocate adopting a very defensive core strategy as the primary approach. Now, we will target prime locations while staying very cautious on fringe locations, right? As you can already tell, the flight to quality is a recurring theme in times like this, as already witnessed in the credit markets. In countries with long lease structures, the likes of Australia, Europe, and US, assets with existing long leases, especially to strong tenants, top our target list. Such leases provide investors with a highly visible income stream to bridge them over this period of extreme uncertainties. And on the other side of the recession, we believe the flush global liquidity would send cap rates ever lower, giving investors of prime locations that added capital appreciation boost. So if one thought that cap rates in London and Sydney were low going into the virus situation, I would say be ready for even lower cap rates in the aftermath of COVID-19. And beyond just a defensive core strategy, I would advocate taking a more thematic approach. Now, we think that the rising tide will float all boats situation is a thing of the past. While beta-oriented investing worked pretty well previously, the coronavirus episode is likely to leave certain legacies that require a more thematic approach to investing going forward. On this note, we would advocate things like align ourselves with very long-term structural drivers. As I mentioned earlier, we like themes like aging demographics, rising healthcare needs. We think this will continue unabated, and we favor real estate catering to this kind of growing demand. Now, another example would be data infrastructure continues to play a catch-up game. The trend towards remote communication is likely to become more deeply entrenched as a result of recent distancing measures. with 5G technologies at our doorsteps, the increase in demand for bandwidth and data storage can only grow. Now, I have also mentioned about resetting logistics and supply chains. So we will look for acceleration towards more localization and regionalization. And on this note, we think that last mile logistics would remain very much in demand. We would also focus more on essentials and be very cautious on discretionary. What this means is, for example, for retail, essentials will always be essentials. Grocery-anchored retail catering to non-discretionary needs have long been a mainstay of the portfolios for conservative investors, and if anything at all, this pandemic has amplified the defensive quality of these assets. Not just retail, even for residential sector, we will move from owner occupation to rent because we believe that the economic repercussions from the virus situation are expected to linger much longer even after the virus has gone. And last but not least, with the amount of market dislocations that have already started and with more yet to come, we simply cannot resist the temptation of going through the distress pile just to see what we can find. It is not our go-to strategy, but given our connections in the real estate space, it would be a waste not to keep our eyes open for such opportunities. And on this note, I would like to end and maybe kickstart the Q&A session. Thank you.
All right, now we'll take the questions. Sorry, can everybody hear me? Hi, can everyone hear me? Yeah. Okay. So now we'll take the questions to come. So we can see from the chat here there are a couple. Yeah, one of them we'll take the first one, which is from TM. TM says that are the case studies actual deals within the RealVantage portfolio? So the answer is not all of them. So out of the 6 case studies that we have presented, 3 are from the RealVantage portfolio. So if I may just give you a view of the deals that is within RealVantage portfolio, you can see here that it is the Joondalup, which is the 7-Eleven service station, and also Curry Street. And then lastly will be the Willoughby Townhouse development. These are in RealVantage portfolio. So the rest would be Keith's, which is our co-founder's personal track record, such as this one, and the one here, the portfolio of Malaysia malls. So this is I hope I answered your question, TM. Next question from Nancy.
Okay, the next question from Nancy is, when you put investment period of 5 years, does that mean you will resell the properties then? The answer is yes, we will exit the asset. What is your exit strategy? Obviously, at that point in time when we are exiting, we are going out there to seek the best possible exit price. So there are a few ways we do it. We can run an expression of interest. It's something like a tender. We go out to the market, we advertise, we get agents to run the process to seek the possible exit price for us, right? That we find is the best way to seek the highest price in the highest selling price in the market, right?
So Teddy asked, can you please explain why the returns for closed-end private real estate was trending down from 2002, while the GDP was actually growing up till 2007? So the reason is this chart plots the returns for funds that were of a certain vintage year. Now, for example, looking at core funds, right? The first data point is in 2001. The 13% return was clocked by all the funds that were established in 2001. And they were able to deploy in an environment when the economy has not rebounded so strongly. Prices tend to be less demanding. And as a result, funds that were deployed during this period would probably fetch a better return. Now, as we progress through the economic recovery, right up till 2007, you would imagine that property prices will be increasing throughout this period. So for funds that were established and started to deploy after 2001, they would be getting in on more expensive entry prices, and therefore that would impact upon their returns ultimately over the 5-year holding period. So I hope that answers your question, Teddy.
Okay, the next question is from Benjamin. What should us as investors do with regards to real estate during this downturn? That's quite a wide question. Obviously, it really depends on each individual where they are right now. If you are in the money, your capital value it's way ahead of what you have invested, then they seriously consider to exit at this point in time. Really, I mean, if the question begs is, can you still exit at the price that you really want, right? But I think really real estate investors should start to seriously think about acquisitions and putting money to work. It will take some time before the economic impact filters down to real estate prices, and it will start softening. We're pretty sure about that, right? That's when it's the right time to pounce. Must always remember, real estate goes in cycles. It goes in cycles, and you always look towards trying to get it at. It's hard to time when you got to get it at the bottom of the cycle, but when it's on a down cycle, it's always a right time to buy, right? The next question we have from TM. The FAQ mentions fees varies from deal to deal. Can you give us a ballpark net fees per transaction? A ballpark net fees per transaction. Well, like I said, it's like we mentioned, it's really case dependent. But as a matter of a ballpark range, we would look at between 50 bips to 75 basis points on the asset value per year. That's what I would say is what we charge. Yeah. Like if it's a more asset intensive project, for example, it's a value add project or an opportunistic project, then the fees will be higher, right? But if it's a core deal, there really isn't very much asset management involved, then the fees will be much lower. It could be as low as 25 basis points a year, all right? The other aspect that we do charge is on performance. So the performance fees is levied above a certain IRR threshold, right? So for example, in a core deal or a value add deal, we might charge something like 20% above 10% IRR. Okay, right.
Okay, so there's and the next question is from Diana. Diana asked a very interesting question. Should we be going more opportunistic during this downturn? Now, I think in times of extreme market stress such as this, investors might instinctively gravitate towards an opportunistic strategy to zoom in on hugely discounted assets. But as we have shown through data earlier on, that adopting such an approach as the go-to strategy might feel like the right thing to do, but history tends have said otherwise. Now, the reason is very simple, because when the discounts come and they seem like they are huge discounts, 20, 30%, 30%, it is extremely difficult to ascertain, whether a 20% is a fair discount or whether it should be 30. That's the first challenge going to opportunistic now. Second of all, the other challenge is real estate data is very much a lagging data, and valuations actually don't mean much at this point in time. Valuations are lagging. All the valuations, you should throw them out the window now. with the virus exploding at the moment. So there's very little things to benchmark against, whether transactions are done at a fair price or not. This is the second biggest challenge. And the third biggest challenge is in the exit. Now, I think Ji Xiang mentioned earlier that when we are looking at opportunistic deals, you're looking towards capital appreciation really to drive your returns. Now, when you are done with whatever turnaround you need to do or development, would the market be at the level where you can offload at your desired price? Is another big question. Hence, I mean, as I mentioned, we would look out for such opportunities, but having the benefit of investing through the previous cycles, we just cannot emphasize enough the importance of adhering to a very disciplined and a long-term investment approach.
All right, so next question here is from Benjamin. Do you guys have distressed assets that you are looking at now? So I think this is a bit related to the previous question, right? Where Mark has elaborated quite extensively. So to answer your question, we are looking at a couple right now. But real estate as an asset class is always a bit lagging behind, right? The wider economy. So we do expect distressed assets to come onto the market in the next couple of months, as now governments are actually introducing new policies saying that landlords must give rent relief to the tenants that are going through these difficult times. So certainly we will expect to see some more distressed assets across our table. And that's what we'll be looking at.
If I may just add on to Ji Xiang's reply, I mentioned earlier that we already have some distressed discounted assets landing on our deal table, and we have been running some numbers. We have been stress testing our numbers, and we have put certain offers out. But I think I also mentioned that this is a time when you want to offer a very low price to a seller. He's going to take a while for the bid-ask spreads to close. So that's the reason why transaction volumes as well as comparables are sorely lacking in this point in time. But we are certainly tracking up on some interesting looking distressed assets. The next question is, wow. Francis asked, what is our view of the AUD trend now? Just a disclaimer. First of all, we are not FX strategists, right? But we certainly keep a panel of FX experts in our orbit. And we do, from time to time, check out their views when we form our own views, right? Now, and I'll tell you one thing, most of the forecasts, they don't even go beyond 3 months, 6 months, or even a year at the most. Vis-a-vis the Sing dollar, Aussie has started peeling off at first, because that's not surprising, because Aussie central bank started to slash the interest rates. And I think Singapore has sort of responded by lowering the appreciation band recently. And that's why the Aussie dollar has somewhat rebounded against the Sing dollar. Now, the $1 million question of where the Aussie dollar is going to hit, I would say, with my very amateurish view and from inputs from our advisors, is that in the near term, the Aussie dollar will remain somewhat weak. Simply because for the first time, the Aussie government is embarking on a quantitative easing program. Now, an important thing to note is that very often Aussie investing into Australia is also somewhat a proxy play on China. And the reason is very simple. China is Australia's biggest export market by far. And being a net exporter economy that Australia is, and looking at how China is well placed to be the first out of the woods. In fact, even a V-shaped recovery for China remains a very viable outcome at this moment in time. So if you ask us, I would say down the road, as the Chinese economy starts to recover, as the Chinese stimulus measures start to feed through, you will see this showing up on Australian shores. This has happened before, just during the GFC episode.
All right. So the next question is from Adika. I'm a bit late to this live webinar. Is there an alternate YouTube link? Yes, we will be putting up these webinars on YouTube as well as our RealVantage platform. So yeah, just look out for email. We will send email after this to give you the link to this webinar. Now, in fact, right, you can see here now that we'll publish this so-called offer, which is basically a banner for you to just click into, and you'll be redirected to the RealVantage platform where you can register as a user if you haven't already. So yeah, just do it anytime you want.
All right. The next question is from Atit. Sorry, I dialed in late. So my question is, since central banks cut down the key interest rates across countries, will it affect the financing costs? When will it be a good time to refinance if there is any? All right, I think that's a good question. Yes, obviously interest rates have come off quite a bit. Central banks across the world have cut rates, but the margins that the banks are charging have actually increased. Just recently, we tracked up on the discussion with a UK financier that we speak to regularly. He says the spreads have gone up from 50 basis points all the way up to 150 basis points. So that's a massive increase. So you got to weigh that into consideration. No doubt your the interest rates have come off, but the margins have gone up. So the next question is, when will it be a good time to refinance if there is any? I think you have to weigh up the total costs. Certainly, I think if the total cost now is cheaper for you to refinance, then I would encourage everyone to go for it. That's I think that's the best way to look at it, right? Next question from EJ. How would you guys handle exit risks? For example, if there was a deal scheduled to exit now during the pandemic. Right. Right now, where we are, if I'm a seller, is not the right time to sell, for sure. Right? There's a massive market dislocation right now. So for us on RealVantage, if you realize, we did mention in our FAQ segment that we have a provision in all our contracts that we do go back to our investors if we think that it's not the right time to exit, and we seek the approval for that. So I think given such current circumstances, this is what we'll do. We'll defer the exit to another 6 months or so, at least 6 months. As you have heard, many governments, not just in Singapore, recently in Australia as well, they've given massive rent reliefs to commercial tenants. So if you are a motivated seller, it's going to be challenging. That's what I would recommend we hold off for at least 6 months.
If I may just add, with all the outsized fiscal stimulus measures announced recently, it's going to take time for these measures to feed through, right? Depending on how each of the governments implement. And, now would be a terrible time, just before the impact of these supportive measures are felt in the economy, to sell now. That's why, as I think Keith mentioned, we would form a view now versus 6 months versus 9 months, whichever it is. We will put across our best recommendation and put it to a vote. And then if 75% of the vote, the investors vote for, elect for an outcome, then as the manager, we will have to execute on that.
Okay, so that seems to be all the questions we have now. Maybe we'll just wait a couple more for any final questions if there are any. All right, if not, I think I would like to thank everybody for tuning in to this webinar today. So as I mentioned earlier, if you have dialed in late or missed this webinar, do not worry, because we'll be sending a follow-up email with the where you can find the recorded webinar at. So yeah, thanks everybody for tuning in.
All right. Thanks everybody. Stay safe.